Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated. Welcome back to the Working Wealth Podcast. I'm Patrick.
And I'm Trevor.
And we are going to talk about insurance.
It's going to be a good one today, Patrick.
Let's do it. Right?
Everyone's favorite topic.
Yeah. And we talked about insurance a little bit in a few different episodes over the past year and a half, 2 years, whatever. But really want to take a deeper dive into, some of the core of like what insurance actually is, what it means, why it's here, why we get it, and really like, what to get and what not to get.
Yeah.
Right. In terms of like some generic recommendations.
Absolutely.
Right.
There are a lot of insurance products out there that get spun as these awesome things that everyone should have. And we're going to talk more about how that may or may not be the case.
Yeah, that's right. Yeah. If everybody should have it, do you really want to have it? That should be the thing we think about.
It's a good
right?
question. Very good question.
But yeah, no, so on a serious note, if you love our content, enjoy it, have seen some past stuff, give us a review, give us a like. We'd love to get some feedback there. And you might get an honorable mention here in the next episode if we see that you actually gave us some content. So keep that in mind. But yeah, anyway, so jumping in for today, right? Talking about insurance. What's the old phrase, the quote? I feel like everybody gets it wrong. The best offense is a good defense.
Yeah.
Something like that, right?
The best offense is a good defense. The best defense is a good offense. It's always like interchangeable. You can go back and forth with it.
Yeah. So really like why we're starting with that today, right, is because in everything we do with financial planning, we like everybody loves to talk about the fun stuff, right? The things that are exciting of like, hey, how do I build my wealth? How do I generate more cash flow? How do I save on taxes? How do I feel like I get ahead in my financial life? But one of the most important things to allow you to get ahead is to have a good defense in place, right? Which is really like the backstop, the risk mitigation, the protection mechanism to ensure you can move forward successfully.
Yeah.
So when we think about insurance, one of the things we want to make sure we talk about is really why we have that in place and what purpose that serves, and then the different kinds, the different ways that can interact with our overall financial plan.
Yep. Sounds great to me.
Perfect.
Let's dig into it.
So let's talk about insurance on a high level. If you had to give a brief, very simple explanation, what is insurance?
Yeah, absolutely. I mean, simply when you look at insurance, what does it do for us? It is really just a way for us to transfer risk in our financial lives. So we've got something that we own. We've got something that we could potentially be liable for down the road that is incredibly expensive. And if we were to lose that or to be hit with a bill that we couldn't manage, we're basically taking insurance, mitigating our own risk, and passing that on to the risk of the insurance policy and the insurance company holding that policy. So we're paying a smaller amount to shift risk from ourselves over to someone else who can handle the burden.
Yeah, love that. That's exactly what I would say. And I think that let's take that a little bit deeper in terms can't talk today. So let's take that a little bit deeper and talk about the specific components of like insurance policies, right? So you mentioned you have like a little bit that you pay in. Yep. We would call that a premium, right? It's like the premium is like, what is the cost for the service you pay for, or like the service you get back, right? Then I would say on the next like highest level is you have a coverage limit. Coverage limit being, hey, here's an associated like dollar amount for a maximum cost or maximum amount of benefit that will be provided for the premium that is paid. And I think those, like to me, those are the two most basic fundamentals of what an insurance policy is, hey, here's how much it costs and here's the benefit you get for that. It's a monetary exchange of value, and that's how we transfer that risk.
Yep, overall. Absolutely. And then I would also throw, with a lot of different policies, we've got deductibles. That's another thing that people are always talking about and thinking about. And really, we will dive more into that, Patrick. But a deductible is just kind of, if the worst is to happen, if I actually need to use my policy, how much out of pocket do I need to pay to kind of enact that and activate that coverage?
Yeah. I love that. Perfect. So let's break down. We talked about transfer of risk. It's really giving us that protection of not having to be thrown off completely by the big experiences that come up.
Yep.
What would we say are some of the core insurance types that we need in place?
Yeah, absolutely. Well, I think first and foremost, we need health insurance. Health insurance is one of the most important types of insurance. I mean, Dave Ramsey quotes this constantly. The largest thing that bankrupts Americans in our entire country is health debt. So going in for medical bills and medical debt would probably be a better way to say that, but medical debt is the number one causer of people going bankrupt in this country. Most people would say, oh, it's credit cards. Oh, it's your mortgage. No, it's actually medical debt.
Yeah.
So I would say that is the number one kind of big ticket item that everyone really needs to have in place.
Yeah, I agree. And I think the statistic that Dave talks about, like in Financial Peace, is like 67% of bankruptcies occur from medical debt.
Yep.
And I feel like I heard something recently as well, and I didn't go back and verify this before today, but it's like the most common reason people like file for bankruptcy is they have debts like no more than $10,000. It's like the amount of just up to $10,000 of that debt that is just unbearable for them to be able to handle or pay off is what leads a lot of people to actually file for that bankruptcy.
Yeah.
And again, most of that being medical debt in those situations.
Yeah.
So we have health insurance. That's a core one we've got to have, because especially with, health costs, medical care costs these days, they're just through the roof, right?
Yeah.
It's exorbitant the way things are billed or structured today. So that's a must. What else do we have after that?
Yeah, absolutely. I would say another really big one, and this is dependent on kind of whether you're owning or renting at the time, but I would say both owner, house insurance, home insurance, and renter's insurance are both musts as well. So protection on where you live, essentially.
Yeah. Right. Gotcha. So having that coverage of if there were a catastrophic situation with damage to your residence, right? Like your home or the place that you're renting, that kind of stuff. One thing I think is good to clarify there too is we think about types of coverage like that, like a home insurance, a renter's insurance, umbrella, auto, those kind of things. Typically those fall under the realm of what we call property and casualty, right? So property and casualty insurance, what that specifically means is we're protecting our property, like having coverage on the property, or we're protecting against like casualty losses, where there's like catastrophic loss, oftentimes a loss of life or like loss of property, in that sense. So home insurance or renters, that's critical. What else we got?
Auto insurance. This is a big one. Everyone hates this one, and I understand it because it's confusing. There are a lot of different elements to it. How much do you need? How much should you have? When, which company should you go with? There's all these questions around auto insurance. I feel like it's kind of one of the big hot topic insurance types out there. But it is a must.
And I would say also it's legally required. Right?
Exactly. And that is an important disclaimer for our audience. It is legally required.
So, and that's one of those things that I think that can exacerbate some of the feelings around certain things is like, well, I have to have it. Therefore, it's like mandatory expense. So that often leads people to try to cost cut. If I have to have it, but I don't really think I'll need it, or I've never had to use it before, how can I find the cheapest? And I think that's where there's a lot of risk of, maybe you have a policy in place that you think it provides what you need, but it doesn't actually provide the amount of coverage you need. We'll break down some of those policy recommendations here in a moment. In addition to that, so we talked about auto, we talked about home and renters, health insurance, umbrella. Right. So umbrella coverage, that's a big one. That's extra liability protection. Which whenever we talk about liability protection, we're really talking about having the legal protection. Who's coming to bat? How much are they willing to pay for us if we have a legal claim? Like if we get sued and somebody's coming after us for our own assets, making sure that we have a shelter of protection, certain amount of limitation where we can't be responsible for anything up to that limit. Essentially.
Absolutely. And that can cover, those policies. We'll get more into this, but they can cover legal fees. They can cover actual like damage and liability. And so they're really great policies to have above and beyond your normal insurance policies.
Yeah, perfect. And then two more that we had on the list is we have long-term disability. right? Any statistics on that?
Yeah, I mean, you are far more likely in America to become disabled at some point in your life than you are to die. So a lot of people hear about the importance of life insurance. You need life insurance, and we would recommend the same as well. We'll talk about that in another episode. But a lot of people don't talk about long-term disability. And really, I can't quote the exact statistic, Patrick, and you might have that off the top of your head, but I see everywhere that you are much, much, much more likely to become disabled in your life than to actually pass away and need a life insurance policy.
Yeah. And I think depending on where you look, those statistics are always going to be a little bit different. I think it's like 4 times to 10 times more likely.
Yep.
And to clarify, everybody's going to die, right?
Absolutely. Yeah,
to
100%
die
of the
prematurely is really what we're talking about here. So yeah, and that is the real thing is the financial impact of an untimely death is usually sudden, it's immediate, it's catastrophic, but the financial impact of becoming disabled and not being able to work to provide income, to fund life's needs and also fund future goals, that is more of a drawn out one, right? It's not as sudden, not as immediate, but it is potentially much longer lasting and can be more detrimental over time because you don't have income, but you are still living and you have expenses, you have needs, things like that over time.
And I think psychologically it makes sense. You know, when I think about my own life, I kind of gravitate towards, oh, well, I know I'm going to die, so I need life insurance, but I don't always think I'm going to become disabled. You know, that's not something that's in my mind. I think most people probably fall in that category of, well, that's not going to happen to me. And I think that's one of the big reasons why we don't really focus on it as much as we should. So.
Yeah, I think that brings us to like that same mindset brings us to the last one, which is the long-term care coverage. And we have this conversation a lot with folks who are getting closer to retirement. I feel like usually it's someone who's in their mid-50s and older as we start to think about, well, hey, like my parents are getting really old and they have a lot of health issues. And now we're having to seriously look at assisted living or in-home nursing care. And I got to think about, well, hey, how expensive this is today. What's that going to be for me down the road? Or what's the impact going to be for my family, for my kids? And it's that same kind of thing. Until we have a situation where we need it, we don't really value it. And the long-term care, that's a whole nother animal. There's a lot of ways to slice that cake or slice that pie today. But the reality is it is costly.
It is.
You know, and there's some great statistics out there too around, you know, the reality of who actually is like in long-term care situations, you know, what are the real costs, how long people actually stay in those situations. And I think people will be surprised to know that historically and based on current numbers, I think the number is you're in a long-term care situation for less than 2 years. Like if you actually need that kind of intentional care, it's not usually lasting more than 2 years. And that's a consideration that we have to look at in terms of the overall financial plan to say, well, does it make sense to pay whatever the premium cost is for 25, 30 years when we might be able to just cash flow or pay out of pocket for expenses when the time comes?
Absolutely.
But not to get into solution mode just yet, right? just laying out all the different kinds of coverage.
And these are all things that people need to be looking at in their own personal financial situations or their families, you know, in the case of long-term care. So I'm excited to talk about it more. Yeah.
Perfect. Well, let's dive in, going back to the top, right? And thinking about the health insurance piece. We're going to have a whole nother episode talking about health insurance and some of the different components there. But if we had to just give some bare bones recommendations, what are we going to say about health insurance right now?
Yeah, absolutely. I mean, healthcare is constantly rising. It's one of the fastest growing sectors in our entire economy. Healthcare costs have just soared through the roof the last 10, 15, 20 years. So having that coverage in place, like we said earlier, is a must. You really need something. And there are a lot of different avenues that you can go about doing that. I mean, most people go through their workplace. You're going to get your health insurance through your employer. And that's a great option. It's usually a lot more cost effective than going through like the marketplace to actually buy your coverage. I would say regardless, and Patrick, you feel free to speak up if you disagree, but I would say regardless of the cost, we need something in place to really protect against those big catastrophic health crises in our lives.
Yeah, and I think that's the key thing, right? The point going back to the original basis of insurance is it is a transfer of risk.
Yep.
So if we're relatively healthy and really our biggest risk is a catastrophic expense like a car accident, a broken arm, a surgery, things like that, heart attack, cancer diagnoses. We need to have some kind of coverage in place to protect us from the catastrophic.
Yep.
If our situation is different where maybe we're not as healthy and we have ongoing conditions, maintenance requirements, medications, specialists, things like that, we especially need to have that in place.
Yep.
But the different kinds of coverage or the way we approach that coverage could be a little bit different.
Yeah.
And I think you kind of alluded to a moment ago, like the source doesn't necessarily matter. If you have an employer-sponsored option, we're going to start there because typically that's going to be your least expensive option overall. If you are employed and they offer that. Outside of that, the marketplace is your next best option, or in general your only option for traditional insurance. But then we have other things like non-traditional insurance. Yeah. And if I can just throw that out there, you guys at least have recently have been on non-traditional, like a health sharing program. There's a lot of different ones out there, Christian Healthcare Ministries, Medishare, Sedera, and there's a lot more that I think are showing up.
I feel like it's becoming kind of a more common practice, kind of the idea of pooling everyone's premiums, their monthly payments into this big pot that is then distributed to people who need it at that time. And that's the main idea of a health sharing plan versus traditional health insurance. You're not paying an insurance company to cover you specifically. You're more paying in, you have coverage in place obviously, but you're paying in, and then your premium might be going to, fund someone else's diagnosis or surgery or whatever it is. And you kind of use it when you need it, rather than having that constant kind of coverage all the time. Yeah.
And I think I'll make a big distinction here. So like at its core, the principle is the same, right? It's a transfer of risk.
Yep.
The big difference is when you go directly through an insurance company, there's a lot more legality involved. There are, funding requirements and obligations. Like they have to maintain solvency. They get audited every year to make sure like they're actually running a business that has the resources to pay out claims in accordance with their pre-negotiated rates or the things that they will actually cover based on the policy documents. Whereas the health sharing, I don't want to say it's the wide open west, but in a regard, it's kind of like it's the wide open west, right?
It really is.
There is not necessarily as clear of guidelines for every specific type of diagnosis code. It's, from my understanding, is more of a panel based, or they have some general guidelines, but there's still people making decisions around, hey, does this money go, like, does this claim get paid, and how does it get paid for? Is money coming from Trevor to go to Johnny over here? Like, how is that actually going to work out? And from an administrative perspective, that's where we see also with health insurance, because it's more of a regulated business, there's a lot more protocols and processes in place. All of that stuff is handled behind the scenes, where they have pre-negotiated rates with doctors, with different networks, with hospital systems, all that stuff, to where it is a lot more black and white. Not saying bad on the non-traditional, but it is just a very big difference people need to understand when they look at choosing their options.
Absolutely.
Over time.
I think that's spot on.
So the core thing though is we've got to have insurance in place, because health insurance costs or medical costs, we'll say, out-of-pocket medical costs are one of the leading causes of financial ruin and bankruptcy these days.
Yeah. And once again, I mean, this can be said about all of these different types of insurance policies, but we're passing the risk from ourselves onto the insurance company or the provider that we're going through. We always recommend people have 3 to 6 months at least of expenses on hand in, a high yield savings account or in a bank account to be able to access quickly. So if you have a $1,000 medical emergency, you have to go and see a specialist or something, or you have a $2,000 or $3,000 medical visit, that's something that, if you're living the Ramsey principles, if you've got that 3 to 6 month emergency fund in place, you can handle that, right? It's not going to be fun. It's going to be an annoyance, but you're going to be able to handle it. We're talking more about the $30,000, the $300,000 procedures that are out of nowhere. Those are the things that are really going to kind of topple your house of cards financially over.
Yeah, exactly. So let's move on to a more relevant one for, well, I guess it's all really relevant. Like another topic here we talked about briefly is the auto insurance side. I think there's a lot of confusion. And like I mentioned a moment ago, is like it is legally required to have insurance to have your car on the road. People look for ways to cut costs all the time. And we had a great episode a couple years ago with a local State Farm agent and friend where we talked a lot about this, but just kind of coming back for the sake of the overview here, I think a lot of people don't understand when they say they have full coverage, that doesn't mean they actually have full coverage.
Yeah.
Or when we think about deductibles and add-on benefits, they don't really understand what goes into that.
Yeah.
So when we look at proper coverage, we'll say proper, right? You got to make sure you have sufficient bodily injury liability. You got to make sure you have sufficient property damage liability. And then if you want to add on things like medical payments, rental coverage, comprehensive and collision, those kind of things, that's where those things are kind of supplemental, right? But starting at the top, a lot of times people go for state minimums. Like in South Carolina, I believe state minimums are $25,000 bodily injury per person, $50,000 for like an aggregate, right, per accident, and then maybe a $25,000 property damage.
I believe that's correct.
I just got to say, like, if I get an accident by myself, like I'm just distracted or a deer runs in front of me and I swerve off the road or, whatever the situation is, and I just damage my own car. These days, it's very likely I'm going to have $25,000 of property damage just from that.
Absolutely.
Right? So, if I were to wreck my own car and I take out, a sign for a business or run into the side of a bridge or whatever that is, you have a lot more expense associated with that. So when we think about getting the right amount of this liability coverage, right, for the bodily injury and, property damage, my recommendation is like, let's at least get 100,000, 300,000, 100.
Yeah. Which is, I feel like that's kind of the next step up in most policies. You kind of see that base coverage. And then I feel like kind of the next option up, which is that, it does increase the price, obviously, but that next kind of step up is usually, from what I've seen, the 100, 300, and 100 amount of coverages.
And if we can afford it, and I would say maybe not just if we can afford it, but if our financial plan dictates it, right? If we have a lot more assets, a lot more resources, more risk we need to protect against, really getting up into that 250, 500, 250 is kind of the next tier. And that's where I like to live, just to make sure that we have enough protection. Heaven forbid a catastrophic situation happen, that's $250,000 of bodily injury coverage per person in an accident, $500,000 as a total, as a cap, and then $250,000 for property damage alone. So that is a really good way to be for adequate coverage. But again, that's just talking about, paying for injuries for people and paying for property damage. Then we have those other things like medical payments. That I think those are pretty standard on most policies today. It's going to also give an additional medical payment per person. And then you have the comprehensive and collision, right? So comprehensive, that's going to be somebody sideswipes me in a parking lot.
Exactly.
Right?
You're
Right?
not moving. Your car is not moving. It's stationary, and something happens to it.
Right. And there's varying deductibles, and that's where I feel like there's a lot more like fluidity with price and coverage. The higher deductible, the lower the cost. Right. Because you're basically saying, if I'm going to take on more of this liability myself, I don't need to pay the insurance company for as much coverage.
Absolutely. Right. And there's a really simple calculation that we can do when we're buying insurance, Patrick. Dave talks about this a lot in FPU, but essentially you can take two different deductibles, find the difference in price of those deductibles, and then kind of calculate how long it's going to take for you to make up that difference in cost with the premium payments that you're making. So you're going to have different premiums for different deductible amounts. You take that difference of, okay, let's just say my deductible was $250. Now I'm going to see what it looks like at $500. So a little bit more risk, a little bit more liability for me if I get into an accident or have my car hit. But that's only a $250 difference in what I would actually pay. Now I go and look at my premiums. How much am I going to be paying monthly or quarterly or semi-annually? And I basically calculate how long it's going to take based on the premium difference to make up that difference in deductible payment. And really, I think if you're kind of in that 12 to 24 month range, I would say that's typically a pretty good kind of, break even point. If you start getting out into the 3, 4, 5, 10 year period, it might be worth looking into a little bit more and really kind of deciding, am I willing to take on that extra risk to kind of break even a lot longer down the road, if that makes sense.
And a lot of that goes back into just the vehicle we're covering, right?
Exactly.
If I have a vehicle that I bought for $3,000 5 years ago, I might not be as concerned about having a $200 deductible, right?
Yeah,
Like,
exactly.
If I could replace the car today for $5,000, I'm not necessarily going to worry about, a dinged door,
Exactly.
that kind of thing.
Yep.
So there's a lot of pieces there, right? So that's like comprehensive. Collision is just, hey, if I actually do get in an accident, what is the deductible that I've got to be on the hook for?
Yeah.
And the insurance company covers the rest, right? For that collision.
Yep.
So there's a lot of things to think about there. One thing I think is important to know is when we talk about those liability limits, those are base limits for the policy. Some companies, some states, you can stack some of those limits together if you have multiple cars involved, or if you just have multiple cars covered. So talking with your individual agent around those nuances is important. But it's from those liability limits, though, that we also can add on top of that umbrella coverage. So let's shift over to umbrella. We talked about it briefly earlier. What would you say is our general recommendation for when to get umbrella coverage and how much?
Yeah, absolutely. There's a lot of different answers to this question. I typically hear $1 million net worth. If you start getting up towards $1 million in total net worth, assets minus liabilities equals this number, and it's $1 million or more, that's when you should really start looking into umbrella policies. Now, that's a recommendation I hear. Me personally, I'm a little bit more risk averse. I like to kind of have things in place in case the worst happens. So I would say really, you can start looking into umbrella policy even at a $500,000 net worth. It really just kind of depends on your comfort level and knowing what the risks are if you were to be liable for a major accident or a major, just catastrophic event and someone decided to come after your assets. If you're afraid of losing the assets that you've built up, it might be worth looking into an umbrella policy to cover those assets.
I think that's a really good way to look at it. It's like if you're concerned about the possibility of having to liquidate or lose those assets, that's when you should seriously have that coverage. And keeping in mind, again, a lot of times you have to have a certain base amount of coverage on the asset before you can add on the umbrella. So a common one is like for our policy, we had to have the 250, 500, 250 on the autos to get the $1 million umbrella. Same thing with home policies, which is where I want to go next. So with home policies, you have a few different types of coverage. You have, and there's a lot of different types of homeowners policies. They're all like called HO, and it's got a number next to it. The core coverages are, you have your property coverage, which is basically your replacement or your rebuild cost. You have separate structures, fences, buildings, sheds, things that are connected to the original property. You would have maybe some medical, some liability, things of that nature. The liability piece on that policy oftentimes also has to be at a certain limit. It's like ours had to be, I believe, $300,000 of liability on the homeowner side to get the $1 million net worth on the umbrella to add on top of that. But let's talk about those core benefits of the homeowner's policy, right? Is you've got to have replacement costs.
This is a big one, Patrick. Most people in America today, unfortunately, do not have enough replacement coverage to actually replace their home if it were to burn down or be blown away. I believe it's around 60% based on a Ramsey study of people don't have enough coverage here. And that is heartbreaking because you see families lose their homes in a horrible hurricane or a fire or something like that. And then they go to their insurance company thinking they've got adequate coverage, and they don't. And they can't actually rebuild the home that they had there. So this is something that we would tell everyone. You need to be checking your homeowner's policy yearly at the very, very least to make sure that it is the coverages are enough to cover your current appraisal value. I mean, homes have shot through the roof in the last 5-6 years since COVID, since the pandemic. So if you're not keeping your insurance coverages high enough to kind of match the growth in homes in America, you're falling behind and you're at risk of losing your property and not being able to replace it.
Yeah, and this has been something we've seen a lot here in our area with the influx of people and massive inflation of home values. There's actually a rule that if you don't have enough coverage for at least 80% of your replacement cost, the insurance company does not have to pay out the full amount.
Wow.
So like if my home is worth, if it would take $500,000 to replace it and my coverage is for $300,000, that's 60% coverage ratio. Then the insurance company doesn't have to pay out the full amount to replace it. They can actually prorate that amount of your actual coverage. So that's an important thing every year, getting that assessed. A lot of good companies have inflation hedges built in. Ours has that built in. A lot of the big ones out there do, but a lot of cut rate carriers, they don't. And it's just the fixed amount and it doesn't go up over time. A lot of times it's a self-service style policy where you go online, you buy the policy yourself because it's based on price. There's no one giving you advice or recommendations on it. And that's where a lot of people get into a bad spot. So we talked about a lot of things here. I want to kind of shift down to some other like kind of supplemental things that aren't technically insurance, but we would consider as part of the defense plan to make sure that we have that in place as a protection. So you mentioned, as we were talking about this episode, identity theft insurance. So what's the thoughts there?
I mean, this is a growing problem globally, but especially in this country. All of us have our information out there somewhere. Most of us have our information in several places. We also, there are whole companies composed of their entire business model is they buy and sell data to large companies, right? And there's just so much risk that you, me, all of everyone out there has zero control over our data being kept safe, secure. Companies love to say that they do that, but we're always constantly hearing about these data breaches and these, these hackers that are getting in and getting social security numbers and getting emails and getting phone numbers and getting addresses. And so this is increasingly becoming a more and more prevalent problem in our society. And therefore, I think that the coverage is more and more relevant each day.
I mean, I'm sure everybody listening has gotten a letter at least once the past 3 years saying, hey, your information was part of a data leak. And it's always, very non-committal. It's like, your information was part of a block of details that could have been accessed. I mean, we literally got one last week from our bank, like a servicing company for the bank. Something happened in 2024. Now there's a class action lawsuit. I might get $300 in recompense. Like
that's pretty good, actually.
I was actually surprised by that. Like $300 is pretty exciting. But it's a real thing, and we've had clients go through this in the past couple of years where it's gotten down to the point of money getting stolen, or transactions being intercepted. As they're trying to just buy a home or buy a car, or find out they have loans on their credit report that they didn't actually sign up for, things like that. As much as we can, protecting against that stuff is important.
And on top of the identity theft protection, Patrick, you and I have talked about this week, actually, just making sure that you're being smart and safe on the internet with all of your different logins and your information, making sure that you're securing it to the best of your ability, changing your passwords regularly, putting dual factor authentication on everything that you can, just putting those small safeguards in place to try to make it harder for someone to steal your information. That's a huge thing that we can do, as individuals, and then also having that actual coverage in place to help us out if something really bad happens.
Yeah, and identity theft protection is super cheap.
Yeah,
it's like it's less than $200 a year.
Yeah, $15, $20 a month usually.
Yeah, to protect your entire family. I'm assuming if you have up to maybe 5 or 6 kids, like all that's covered for that same price.
Yeah,
I know we pay, I think, $140 a year to have that, and it locks down your socials, it locks down emails or phone numbers, looks for that stuff out on the internet, and gives you notifications if things happen, and it also provides you that back end where there's people that will go and pursue and resolve issues that come up for you. But the best thing is just mitigation, like reduce the possibility of risk as much as possible. Don't text your social security number to somebody.
Please don't.
Don't respond to those kind of inquiries or the fake, DMV texts that are going out around, hey, you got a ticket, you need to pay, follow this link. all that stuff is fake.
Your bank will never call you asking for your routing and your account number.
Yeah.
If that happens, pick up the phone and call your bank.
Yes.
And they will tell you it's a scam. I mean, just be careful, especially younger people who are just getting into kind of, adulthood, and older people who are, more susceptible to these things. Just need to be very diligent and very careful. Double check everything when someone reaches out to you asking for information.
Yeah, agreed on that. Last one of a type of protection that we got to make sure we have is a solid estate plan.
Yep. This one gets missed a lot.
Yes.
And we talk to people every day who don't have anything in place for their families. Mm-hmm. Patrick, you actually, you just got another license, another credential in this space. Exactly. Talk a little bit more about, why estate planning is so critical.
Yeah. So specifically for like the credential side, so really got into the exit planning side with business owners, right? Yeah. And making sure that we have a clear plan of how we're going to transition assets or, capitalize on assets going forward into, the next season of life, mm-hmm. right? If I'm getting out of being an entrepreneur, selling my business, transitioning, closing it down, things like that. And that really ties in with the estate planning piece of making sure that we have a plan. Yeah. Like for business owners specifically, most oftentimes we're so focused on building, maintaining, growing, sustaining the business that we forget about what the down the road looks like of, well, how do I actually
exit?
Yeah.
How do I retire at some point?
Right. And I think it's important to also apply that back to just the personal side for everybody in general, which is eventually at some point in time, you are going to pass away. Yeah. And where a lot of times things get messed up or they don't get planned out appropriately is we think, well, hey, it's not an imminent thing. It's a future issue I'll have to deal with. I'm really not going to have to worry about that right now. So therefore, I'm just going to push that off. Mm-hmm. And a lot of times, like even if we're leading Financial Peace University, the conversation is, well, I don't have any assets or I'm in debt. Like, why do I need to have this stuff in place?
I don't want to pay an attorney $1,000 to get a will in place. That's a big cost for a lot of people.
It is. Yeah. And it's a sunk cost, mm-hmm. right? It's you're paying for expertise and to put a legal protection or legal plan in place. Yep. But I think the estate planning side it's more than just the will. It's how am I leaving the right instructions in place, mm-hmm. Time and date stamped saying, hey, these are my wishes when I can no longer speak for myself, whether that is through death or it's even sometimes through disability. Yeah. And that's where we say the estate planning piece is really 3 core documents you should have, or we would recommend you have, is you got to have a will, right? Because that gives direction on all the assets, all the wishes that are not captured through beneficiary elections or proper legal titling elsewhere. Mm-hmm. Second thing is we need to have powers of attorney. Yep. And that's where you're granting someone else that legal ability to act or speak on your behalf when you, again, can't speak for yourself. Yep. Transacting on business, making sure the right things are accomplished for you over time. Yep. And the third piece is the medical directives. Yeah. And this is not as fun of a topic, right?
Definitely not a fun one to think about, but very necessary.
Very, very necessary. Mm-hmm. And it's those things like, hey, do I want to be an organ donor? Mm-hmm. If I'm receiving, computer generated care, right? Yeah. Like, if I'm on life support, essentially, if I need feeding tubes, if, there's no brain activity in my body and somebody needs to make a decision, those kind of things. Yeah. That's where having these things documented appropriately and sharing the decisions with the people you're designating to be the active parties is very, very critical.
And Patrick, I love what you just said there. I think that is so massive. Sharing the information with the people that are involved. If you've got someone in your will, you've got someone listed as a power of attorney, as a durable or a medical power of attorney, have a conversation with them. Say, hey, just so you know, if this, and this happens, you actually have this role if you want it. And I have appointed you because I trust you. I think that goes a long way in just not blindsiding people that we love and care about, because we're putting these people in charge of if we're not in charge. And have the conversation ahead of time. A lot of people get weird about this and they don't want to talk to people about it. And I understand that hesitancy. It's a strange conversation to have, but people will thank you for actually communicating with them and letting them know ahead of time, hey, these are my wishes. This is what I have in place. This is how you're involved with that.
Yeah. And once you have them in place too, is don't be afraid to reassess. Yeah. One of the biggest things we see with folks going into retirement or newly retired is, we always review the estate plan, because this ties into beneficiary elections on investment accounts. It ties into survivorship options on pensions or even Social Security, things of that nature. And we often get the response of, oh yeah, we did our will, when our kids were young. Well, your youngest is 33 now. So I think it's a little bit out of date and we need to go back and revisit it. And there is that hesitancy around cost and like, should I spend money on these things? But I think working with a good quality attorney who has experience that offers a good, foundational service is important.
Absolutely.
And if you don't have that resource, there are a lot of great online programs these days that will guide you through, thinking about these decisions, making the final decision and putting it on paper to get executed. I'm always a big fan though, work with a professional, someone who does this.
Agreed.
So finding that person who's trustworthy, you can walk through and sit down and navigate nuance is important from my perspective. But at a bare minimum, spend a few $100s, go online and use one of those platforms. And I think the biggest thing that a lot of people don't think about, especially if they are working on paying off debt or they don't have a lot of assets and they think it's really not important, is guardianship. If you have kids who are not adults, or if you have soon to be adult children that you really don't want to leave them in a mess, right? You want to make sure that there's assets that are there, but you don't want them to just receive everything at 18 kind of thing. You have to have the will in place to provide that kind of protection for your heirs, for your kids, because otherwise those decisions do often default back to whoever the state appointed party is, which should be someone who's a relative. Most oftentimes it is a relative. But the question becomes, hey, do you want that to be that specific relative? Or do you have specific desires around, we want these people to care for our kids and these people to manage the money for our kids? Those are really important decisions we've got to make sure we have locked in place.
Absolutely. That's great. I've got no other additions to the estate side. I just... my wife and I just got our estate put in place
yesterday.
Yesterday, exactly. And so it's so important. You're never too young. You're never too early in your financial stage to have these protections in place for you, your family, your loved ones. And even if you're single, I think I hear that a lot. Oh, well, I'm single. I don't have anyone to give anything to or anyone relying on me. It really doesn't matter. We should still have something in place that dictates where the things that we own go, or where really just how everything flows after we're gone. And I just can't speak to the importance enough.
Awesome. Well, I think we covered a lot of really good stuff really fast on the basics of insurance and the insurance that we should definitely have. We'll call that the end of part 1, right? We'll come back here with the next episode on part 2 about maybe some insurances to avoid and some of the gotchas, some of the traps around really how we should think critically about whatever is being offered to us by whoever's trying to sell it to us. So if you like the content, again, give us some feedback. We'd love that. And we'll see you guys with part 2 coming up soon. Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated.